Lesson: Establishing objectives for compliance audits. Establishing objectives for compliance audits is a critical step in ensuring that an organization meets its legal, ethical, and operational standards. A well-defined objective not only guides the audit process, but also ensures that the audit adds value to the organization by highlighting areas of improvement and ensuring adherence to compliance requirements. This lesson will provide actionable insights, practical tools, and frameworks to help professionals effectively establish objectives for compliance audits. The first step in establishing objectives for compliance audits is to understand the regulatory landscape and organizational context. Compliance requirements vary significantly across industries and jurisdictions. Therefore, auditors must be well-versed in the relevant laws, regulations, and standards applicable to their organization. For instance, a healthcare organization may need to comply with the Health Insurance Portability and Accountability Act in the United States, while a financial institution may need to adhere to the Sarbanes-Oxley Act. Understanding these requirements helps in defining the scope and focus of the audit. The second step involves engaging with key stakeholders within the organization to gather insights and understand their expectations. Stakeholders can include senior management, compliance officers, legal advisors, and department heads. Their input is invaluable in identifying potential risk areas and prioritizing audit objectives. A practical tool for facilitating this engagement is the use of a stakeholder analysis matrix, which helps in mapping out stakeholders' influence and interest in the audit process. This matrix aids in identifying which stakeholders need to be consulted or kept informed throughout the audit process. Once the regulatory landscape and stakeholder expectations are clear, the next step is to define specific, measurable, achievable, relevant, and time-bound objectives for the audit. SMART objectives ensure that the audit is focused and results-oriented. For example, an objective might be to evaluate the effectiveness of internal controls related to data privacy within 6 months. This objective is specific, measurable, achievable, relevant, and time-bound. Risk assessment is a critical component in establishing audit objectives. Auditors must identify and prioritize risks based on their likelihood and impact on the organization. A common framework used for risk assessment is the COSO Enterprise Risk Management Framework, which provides a structured approach to identifying, assessing, and managing risks. By using this framework, auditors can focus their objectives on high-risk areas, ensuring that the audit addresses the most significant compliance challenges faced by the organization. In addition to risk assessment, another practical framework that can be employed is the Plan, Do, Check, Act cycle. This iterative process helps in continuously improving compliance processes and controls. During the planning phase, auditors establish objectives and develop an audit plan. The doing phase involves executing the audit according to the plan. The checking phase includes reviewing and analyzing audit findings, while the acting phase involves implementing corrective actions based on the findings. This cyclical approach not only helps in establishing clear objectives, but also in ensuring continuous improvement in compliance practices. A case study illustrating the importance of establishing clear objectives is the compliance audit conducted by a multinational corporation in the manufacturing sector. The company faced significant compliance challenges due to varying environmental regulations across different countries. By engaging with stakeholders and conducting a thorough risk assessment, the audit team was able to establish SMART objectives focused on high-risk areas such as waste management and emissions control. The audit resulted in the identification of several non-compliance issues, leading to the implementation of corrective actions and improved compliance with environmental regulations. Another example is the use of data analytics in establishing audit objectives. Modern compliance audits often involve analyzing large volumes of data to identify patterns and anomalies. By leveraging data analytics tools, auditors can establish objectives that focus on detecting fraud, errors, or inefficiencies in compliance processes. For instance, an audit objective might be to analyze transaction data to identify potential instances of bribery or corruption. Data analytics not only enhances the effectiveness of the audit, but also provides valuable insights for decision-making. Establishing objectives for compliance audits also requires a consideration of ethical considerations. Auditors must ensure that their objectives align with ethical standards and promote transparency and accountability within the organization. This involves maintaining independence and objectivity throughout the audit process. Additionally, auditors should be mindful of the potential impact of their findings on stakeholders and ensure that their recommendations promote ethical behavior and compliance with legal and regulatory requirements. In conclusion, establishing objectives for compliance audits is a crucial process that requires a thorough understanding of regulatory requirements, stakeholder expectations, and organizational risks. By employing practical tools and frameworks such as stakeholder analysis, the SMART criteria, risk assessment frameworks like COSO-RM, and the PDCA cycle, auditors can establish clear and effective objectives. These objectives not only guide the audit process, but also ensure that the audit adds value to the organization by enhancing compliance and promoting continuous improvement. Through the integration of data analytics and ethical considerations, auditors can further enhance the effectiveness and impact of compliance audits, addressing real-world challenges and improving organizational proficiency in compliance management.